Hello everyone, this is Taha, financial market analyst in zForex, and this is our weekly video analysis, so welcome abroad.
Hello everyone, this is Muhammad Taha Bukhari, and it's our weekly financial analysis. Let's start it. So if we would start with the US, and especially the non-farm payroll, with the last data that they were the last week, especially on Friday, where we have an NFP. The US economy created 187,000 jobs, which was lower than expected, which it was 200. This has a negative impact on the dollar. You can see the dollar that was a sell-off on the dollar. This sell-off on the dollar that we were able to see, this red candle, especially on the 4-hour, or those candles on the 1-hour, it was limited for the reason that even if the NFP was lower than expected, the other things that the average wages, also the unemployment, the wages are higher than expected, than forecasted, and also the unemployment is going low, 3.5%, which it's lowest of the lowest, which those two components, they are so much not going well in terms of what the Federal Reserve want them to be. So even if we had this NFP that is lower, the impact was limited, and today we are seeing that the dollar is coming back. So the idea here that this data, okay, they gave this sentiment that this reading that labor market is slowing in the US, but in the same time the wages, the important component of influencing inflation, plus the unemployment rate that the Federal Reserve wants to be higher than the actual level, is going back from 3.6 to 3.5, which is not welcomed by the Federal Reserve. So this week for the dollar and US economy, the most important thing will be the CPI, the core CPI, where we have the core inflation, which will give us an idea about where is going inflation right now. We know that inflation in the USA it's slowing, so which is a positive for the economy. But in the same time, the most important thing is that if we will see continuation in drop in inflation, as we know that the USA, the Federal Reserve wanted 2% target. Right now we are 3%, and we saw this fall in inflation in the US, which is so much positive. Instead, if we compare to European Union, where inflation is not that much, it's slowing but still sticky, especially on the core. So even for the US, the core inflation it's slowing, which is a good indicator for the USA. So we can see clearly that even in the core inflation is going back to 4.8%. So inflation in the USA is better than the European Union, but we will see and confirm this in this week data. Especially our biggest topic right now is if the US is going for a soft landing. All the data right now are giving more probability and possibility of there is a more possibility of US having a soft landing, not going to a recession. Instead of that, where the European Union, especially the Euro, and especially some economies, big economies like Germany, where we will have this week some data, especially about industrial production, and we were able to see the PMIs especially from Germany, also from other countries like France and like Italy, like Spain, where the data were not that much welcomed. We can see the manufacturing PMI from Germany, which is really dropping lower and lower. Contraction territory, the 50 point is the neutral point. We are at 38, which is so much low, which is negative for the industrial production and manufacturing index of PMI in the Germany, and this is a negative thing especially for the trade balance, especially for the exportations, and give us an idea about the economy right now in Germany. So we are going low and low. Other countries similar in the European Union, the data are not good. So this indicates something. It may indicate a possibility of a recession in the future, and this may not be good that much for Euro. So if we compare this with the US still able to keep itself against this slowdown in an economy, you assume that it's resilient. We can see the PMI in the US. Okay, it's lower, but not similar to what is happening in the European Union. Also, like I said, for the dollar, we can see that in terms of Eurodollar, we are able to see that the Eurodollar, like this correction that happened in Friday, we have this channel in Eurodollar where we came back to the 1.10.5, close to 1.10.4. That was the resistance. We have this beautiful channel, this downtrend line. It's keeping itself. So the next target will be, first of all, going back to 1.09, going back until the 1.085, especially this week. Especially this level, that is a historical level, so much important, coming from, we saw it from like May 2023, May, again in June, July. So it could be the next level if euro continues to continue going down, and the dollar, if we get a good data for the dollar, so this may lead to more sell-off on the euro dollar. There is another thing important for the dollar is the FOMC members, that the members of the FOMC of the Federal Reserve, that they will speak. These speeches will have an impact, especially on Monday. So you should be careful from what they will say. Right now, the market is pricing that the Federal Reserve may not increase in September, but they may have a last. It is low probability right now, around 27%, that they may increase in the next one last hike this year, but it's still low. The market is more pricing that the Federal Reserve will not hike, and where the interest rate is right now, it's enough. So we'll see where things can go. So if this is for the euro dollar, the XY, we can take a look on the XY. The XY, similar. We had this comeback to the 1.180s levels, where we have the 200 moving averages. It's a support resistance level, so it's an important level. So coming back, we'll go back to the 102.85 as a first resistance level, continuing to the next important and historical level, which is the 103.4, where it will be a good resistance level for the XY. Or other than that, one of the most important data this week will be for the pound, and especially for the UK. The UK will face data concerning the GDP. So right now, the UK, one of the biggest problem that the UK is facing is inflation. It's a sticky inflation that is not making things easy for the central bank to be careful about raising interest rates. It was, and it is still, a problem for them to stop hiking rates. Right now, we are beyond 5%, and they may go to 6%, which may be so much harmful for the economy. Right now at 5.25, which is so much high. Another increase in interest rates may mean more probability of a recession inside the economy, especially right now. The biggest problem right now is inflation, and especially the core inflation, that is not slowing down, but more than this, going up. And we can see that we are at 6.9, which is a higher level for a country like UK. So the GDP for this week will be influential for the economy in the UK. I remember the last from 2 weeks. We saw IMF making its forecasts and projecting that the UK may make some good results in terms of growth. We will see in this week how this will be impactful. The data will come in Friday for UK. The impact on pound dollar. Pound dollar is suffering for one reason, that the market is watching the economy, and there is if there is a country in the developed world where there is a big probability of a recession, it will be UK. High interest rate, higher inflation, higher core inflation, Federal Reserve does not the BOE does not have a lot of choices than increasing rates. This could be so much impactful in the economy in the long run, starting from especially the housing market, where the mortgage rates are so much higher right now. The pound dollar as a pair, it's continuing down. We touched the 1.266 levels. We are coming back, but a breakout of this level will take us to the 1.256, and a more sell-off. We can see lower lows at the 1.25 and 1.24. As before, we had this long run on pound dollar. We are having correction. This level, we will have 100 moving average at the 1.25 levels, and coming back until the most important level that will be around the solid level could be on the long run if the sell-off continue is the 1.23. So this is for the pound dollar. Like I said, it's more influenced by an economy that is the pound, that is the UK, that is slowing down. Market is forecasting that interest rates that are so much, we may take to a recession, to an economy that is the US, where it seems more resilient, it seems more going toward a soft landing. Rather than that, we have the yen. It's so much like dramatic what is happening in the yen, where the Bank of Japan, even if we want to see the yields in the yields curve control, that the control of the 10 years, especially it was 0 plus 0.25 to minus 0.20, minus plus 0.5 to minus 0.5. Right now is going to 1% as levels where the yields can play. So this was a positive at first glance for the Japanese monetary policy, especially right now, restrictive policy by the Bank of Japan with the lower interest rates, zero interest rates, also pushing the economy as the Bank of Japan, especially the president of the Bank of Japan, who keeps talking about the possibility for keeping the economy at least see some good levels in terms of increase in wage and in inflation for a more longer time, to change and to change the actual monetary policy that was negative for the Japanese yen. We saw correction first of all from after we saw a correction after touching the 143.8, but with the actual levels, if the dollar continue up, yen still weak, so we may see come back to the 143 and maybe the 144, and beyond 144 we may go to the 145, and this level 145 is so much important for the Bank of Japan, so much important for the Ministry of Finance, where the last time in June 23, they start talking that at those levels the officials may start intervening in the market to help the yen from falling more. So we'll see what happened to the yen. Right now, the dollar is still bullish. We had this correction, but this correction is not enough. The dollar is high. We will see what will happen with the CPI. That is the most important things, and that's what we have right now. There is another last thing is the dollar Canadian. The thing is, we are at right now at a resistance level, and this resistance level, especially with the dollar Canadian, right now we may have a reversal. Canadian right now is not that much impacted by oil prices that are going higher and high. We will see what could be the result of this, but at right now this pattern, the double top and a possible reversal, the next level we will have the 1.34 first resistance level, continuing maybe until the 1.365 in the long run if the dollar continue being strong. But the oil prices, they may help Canadian, but the dollar still the strongest pair. So this is what we have this week. I wish that was helpful for you, and thank you, and see you the next week. Bye bye.